From our audience worldwide, good evening and welcome to Money Matters. On today's diary, we will discuss the international foreign exchange market, cross rates, the commodities market, and the conversation section. I am Malik M. Jallo, and this is Money Matters. Welcome back. So let's take a look at the foreign exchange market. Currencies have been performing. That is, the euro has been performing stronger against the dollar. So does the dollar and the pound sterling. The global monetary policy tightening race has just got more intense as the Federal Reserve delivered yet another 75 basis point hike, followed by the Bank of England and the European Central Bank. This has seen a global rally in terms of interest rate hikes with the objective to tame the historically high inflation. Dollar has not been doing very well for the past week. It has indicated depreciation against the dollar at the end of the week by 4.10% and against the pound sterling by 5.04% and against the euro by 5.56. This has indicated a strong recovery or stronger currencies, and dollar has been really depreciating and fast compared to the previous week. The US dollar opened at 58.05 and closed at 60.97. That is a very quick spike, as you can see illustrated in front of your screens. This still indicates the dollar still remains dominant. The euro opened at 57.37 and closed at 60.33. Euro also has shown great recovery compared to the past weeks, as we have seen that the European Central Bank is moving forward faster in its tightening monetary policy stance, and also the fears of inflation is also accelerating their strategy, yet the fears of recession has not gone. The pound sterling opened at 66.84 and closed at 68.79. This is a steady performance of the pound sterling compared to the past week. The lowest it has recorded is 65.49 on the week, but it closed back higher. Since Rishi Sunak took over as the Prime Minister, we have seen pound doing much more better as the direction of the fiscal policy is much more clear. On the international cross rates, euro opened at 0.98 against the dollar, which means euro is still below parity, and closed at 0.9895. Pound opened at 1.15 and it also closed at 1.128. If you look at the illustrations before your screen, you will realize that we have a steady pound dropping and then picking up again, and euro has remained relatively stable, but it dropped to 0.97 on the 3rd of November, but later picked up to 0.98. So is the dollar dominance really fading? Well, it doesn't seem so, because the Federal Reserve continues to hike rates, and even though they have indicated their intention to reduce the rate of increment from 75 basis point to a possible 50 basis point, dollar still remains stronger and dominant against major currencies. That was what we have for you in the foreign exchange market, and when we are back, we flip the board and look at the commodities market. Welcome back. We have looked at the international foreign exchange market and international cross rates. Now let's take a look at the commodities market. Brent crude has been steadily increasing. It opened at 96 and closed at 99. Some months ago, somewhere in July, August, or September, the OPEC indicated its strategy to reduce oil supply by 2 million barrels, which represent at least 2% of the global oil supply. And this has raised the anticipation or the expectation of a higher gradual increment in price on oil futures, which is what is indicated by our illustration. And China is also still not yet open fully, and it's a huge player in terms of oil imports. Gold opened at 1650, but it closed at 1680. This happened quickly before the Federal Reserve hike another 75 basis point. And also, while the inflation numbers in the United States has indicated a sense of cooling off, although still high compared to historical levels, the investors are becoming much more comfortable with buying more gold and avoiding the US dollar. But I must say the US dollar is still attractive in terms of investments and yields. And rice also opened at 16.40 but closed at 17.40. So that is what we have for you today on Money Matters. We have looked at the foreign exchange market, the commodities market, and when we come back, we will look at the conversation segment. Thank you.
Gambia mumbe talti, mbe killing, dimbaya killing. Akumaya tabake, pour nse Cairo sabatindin tema. QTV kachadula, betaman tamangla West Coast region, pour ka Cairo sabatindin tema. Kili follow Birkama Governor's Office, November karo atilisei 2022. Talan sabatili bulo, Combo East, Combo Central, Combo South, Combo North, Tilifula Nyong, Brikama Governor's Office, Tili Kononto, November karo 2022, Talan sabatili bulo, Fonyi Berefet, Fonyi Bintang, Fonyi Kansala, Fonyi Bondali, Fonyi Jarol, Sefolu, Musunyaton Kolu, Fonding Kelu, Village Development Committee, Molu Milialonko ebe sabatiring West Coast Region, Mbebe Bunyala nyim programoto. Cairo mu fen kummayari mbalti woto mbe ngambulo dundije.
Welcome back. We have looked at the international foreign exchange market, we have looked at commodities market, and now we are heading to the conversation segment of Money Matters. With me today is Mrs. Njilan Senghor, the Managing Director of Trust Bank Gambia. And our topic of discussion is going to be the risk exposures, the exposures that commercial banks have by holding government long-term maturities, which are bonds. Mrs. Senghor, welcome and thank you for honoring our invitation to Money Matters.
Thank you, Malik. You're most welcome.
Great. Let's get straight to the point. From the past 2 years, the Ministry of Finance have rolled out a bond program. And according to the objectives is to reprofile the debt maturity and also reduce refinancing risk. What the major holders of the issuances of the bonds are commercial banks.
Yeah.
So before I ask the question, what are the risks, what is the main objective? What drives the commercial banks towards lending into long-term maturities?
Okay. Thank you, Malik. I think historically in the Gambia, we have not seen many issuances of long-term securities. So you're right. It's something that the government has been looking at recently in order to reprofile their maturities. I think in 2017 or thereabouts, government had reprofiled some NAWEC debt. But banks were already exposed, so it was already on balance sheet. So this was not anything that the banks took a decision to invest in. It was already there. But right now, why would banks consider holding investments in long-term securities? It's a good question. It's a good question because there's a reason why banks liked investing in treasury bills. Because you have depositors' funds, and you use the depositors' funds to participate in financial intermediation on the one hand, and also to participate in what we consider to be risk-free lending of assets that are easily convertible to cash, which were the treasury bills. And we had those in different profiles, 3 months, 6 months, 12 months. And banks were able to utilize the different profiles based on their liquidity needs to be able to convert easily to cash while still earning some investment returns. But we've seen recently that government is moving away from treasury bills to the bond market for reasons that you have already mentioned. Is it an easy decision for banks to make? I don't know about other banks, but for us it is not. Because the shortest tenor here is 3 years. Mm-hmm. Yeah. And banks are being asked to take a conscious decision to lock funds in a 3-year investment at locked interest rates. So it exposes banks to, number one, asset mismatch risk, meaning that you're holding short-term depositor funds and you're investing them in longer-term assets, knowing that the rates are locked and knowing also that the rates may turn against you. That's the decision we're being asked to make. And the other risk is liquidity risk. Like I said, we liked investing in treasury bills because we had different profiles and they were easily converted to cash because the tenors were shorter. And initially, treasury bills, actually, we were able to rediscount it at the central bank and convert it to cash if our liquidity needs warranted it. So to lock them in bonds now with no exit strategy, because there is no secondary market for the bonds, it means you're taking a conscious decision to say, I'm investing at a fixed term rate and I will not be able to get my money back until maturity. And it's a difficult decision for banks to make because, number one, the mismatch. Number two, interest rate risk, because it is very likely that the rates will turn against you. And number three, liquidity risk, because it is not near cash. You cannot easily convert it to cash. And you cannot even include it in the calculation of your liquidity ratio. And these are all regulatory ratios. So the central bank has a minimum liquidity ratio for banks to meet. And when you invest in bonds, same as when you give out loans, you cannot consider that to be part of your liquidity ratio. So yeah, that's the issue we are having. But then again, it's a very difficult decision to make because what else do you do?
That was where I was going to head.
Yeah, okay.
That was where I was going to head to, which I will let you dive into. Yeah, what else do we have? What else do banks have? What alternative investments do we have in this macroeconomic environment?
Yeah. See, the central bank has long bemoaned the fact that banks do not participate in financial intermediation. I remember a few years ago, as part of their expansionary monetary policy stance, they decided to loosen the rates and they reduced the cash reserve requirement rate to free up more liquidity. In communications with them, the thinking behind that was to free up more liquidity for banks to be able to lend more. My question has always been, I've been in the industry 15 years. I don't remember, I'm not saying it hasn't happened, but I don't remember reading any MPC report that highlighted liquidity as a challenge for the industry. So my question was, are banks not lending because of liquidity stress? Or is there another reason? So is freeing up the liquidity going to guarantee that there will be more financial intermediation? And I don't think that was the case. In fact, freeing up the liquidity put more pressure on the treasury bill market because banks headed straight there. We are regulated by an act that really restricts what else we can do. So it's between government securities or financial intermediation.
So would you say technically, that the freeing up of liquidity actually helped government to ease the debt burden on the government? Because if there is excess liquidity in the market and that's going to push the yields down, and then the cost of borrowing is going to be cheaper for government, but instead the funds are not going to the real economy. Why is it not injected in the real economy?
It is not injected into the real economy because banks are afraid of the risks associated with lending. We have liquidity deposits of about 53 billion at the moment, and industry loan to deposit ratio is 25%. So even where banks are not able to purchase government securities, that excess liquidity is lying at a central bank at zero interest, which doesn't make sense. So it begs the question, why are banks not lending? It's simple. And in the layman's term, banks think that banking activity is a lesser evil than bank failure as a result of bad lending. We have a long way to go. I was having a conversation with someone once, and they said, if you have a property that you cannot sell, just go and give it out to a bank as collateral. Meaning straight away there's an intention to borrow and not pay. We have industries here that are not as regulated as banks are. We have industries that cannot even provide simple things like audited financial statements. A lot of thinking in this market is that lending is on the basis of collateral only. And I think we've had our hands burnt so many times that all banks have reassessed their credit assessment criteria. And collateral is one of 5 things that we look at, and it is not the most important.
I had Dr. Jami here last week, and we discussed a little bit on this. And what he said, in order to encourage banks to invest in the real economy, because credit creation only happens through the bank, or let's say the largest proportion of money creation happens through the commercial banks when they issue out loans. And it's a huge stimulating economic factor when you have finance injected through commercial loans and all that. And he said that for commercial banks are unable to price in the risk. Let's say, for instance, he picked the agricultural sector. He said commercial banks they're good at pricing the financial risk. But let's say they want to invest in the agricultural sector. They cannot price in the risk in the agriculture sector. So he said central banks should come in with a project that's a sort of guarantee that encourage commercial banks to get into the agricultural sector by de-risking the agricultural sector. Now, what would you say? Would that be an incentive, or do you think that will encourage commercial banks? Because allowing liquidity to come in is like when you just do quantitative easing, pump in much more money in the balance sheet of the banks. You cannot force them to release the liquidity. So, do you think that could be an incentive to allow banks get into the real sector?
It could be, but you're just talking about one sector here, right? There are many sectors that need banks intermediation. But the problems are general. The problems are we need a more operational, should I say, credit reference bureau, for example, because assessing credit history for borrowers is a little bit more difficult without it. We need to ease the legal process of liquidating collaterals if we get to that. The process right now is a real hindrance to borrowing. We need a mortgage act, if possible, that makes it easier for banks to execute when it is time to sell collateral. We need some sort of better regulation of most industries so that banks will be able to gain the knowledge that they need to understand specific industry issues. And you need to understand who you're lending to. You need to understand the way that sectors behave so that you can price risk appropriately.
Okay. So from what you have said earlier, and the fact that the 2022-2026 medium-term debt strategy of the government still indicates more bonds as to the strategy they are trying to practicalize, is that no new borrowings are likely to come in the treasury bill market, only refinancing the maturities. So more bonds, more long-term, and the holders are commercial banks, which means commercial banks getting more committed into long-term. Is this not posing a huge risk to the entire financial system if this continues without an exit strategy?
Yeah. We've had discussions with officials of the ministry, and there are certain things we talk about. We talk about the fact that there's no secondary market, so there's no exit strategy for the bonds. The argument could be that when you lend, there's no exit strategy either. You have to see it through. But lending allows you to be able to reprice if the rates turn against you. You don't have that option with the bond market. So interest rate risk is really a challenge when it comes to bonds. Like I said, you're not even able to include that in your capital adequacy, not capital adequacy, in your liquidity, calculations. In the previous treasury bill market, those challenges were not there, like I said, because you could convert it to cash easily if you need. But imagine in your balance sheet, you have demand deposits as your funding base, and their demand, as in anytime your depositor wants to get them, they can. And then you use those funds and finance lending, and then you buy bonds. So imagine how your balance sheet now looks, where your liabilities are short-term and demand-driven, and your asset side is locked in investments of 3 to 5 years, because that's what the average tenor is for loans. So isn't that creating a liquidity crisis? When your demand depositors come, it's very unlikely, because most banks here are adequately capitalized, they have good liquidities and so on. So it is very unlikely that there will be a bank run. But we always have to do stress testing, and we always have to act responsibly to make sure that in the event that your depositors come in their numbers and say they want their deposits back, you need to be able to easily convert them to cash to give it back.
What should policymakers do in terms of deepening, because the government is on a path to develop the debt market? What should be in place to strengthen this, to ensure that the debt market really functions efficiently and effectively, not only for commercial banks to participate safely, but also businesses to raise capital, the kind of businesses we have. The talk of capital markets, it's on the way. How do we explore that opportunity? What do you think should be in place for us to explore, to maximize the opportunity of a capital market?
Yes, there's been talk about developing a capital market, and at the moment the central bank is engaging banks because they are considered to be one of the most active participants, who would be the most active participants in that market. We're at a talking stage, but I can tell you a little bit about our experience because we are quoted on a stock exchange. African stock exchange markets are usually dealing with the same perennial problems of illiquidity. They're dealing with a lot of governance-related issues because in our countries, some industries are very regulated, like banks, which is why the central bank is looking at banks as being major participants in the stock exchange. But a lot of industries, a lot of businesses are not regulated, and a stock market requires proper governance structures, audited accounts must be presented, and so many other things that I think need to be worked on before we get into.
So what you're saying, technically, we need to get the fundamentals right.
We need to get the fundamentals.
Because, like, for instance, what kind of businesses do we have? Like, what are we going to have? Because the stock exchange is supposed to, is supposed to create liquidity. It's not to have a stock exchange and capital market and still they're still illiquid. So what would you say is the right type of businesses, or what do you think, besides governance and other things? What do you think should be in place for these fundamentals to work properly? And if those fundamentals are ignored and we will go ahead with the capital market, is this really going to work effectively?
I am afraid it may not work, but in the long run, there's a lot of learning that will happen and things will improve. We saw that on the Ghana Stock Exchange. I think it's doing a lot better now in terms of ranking of performance of stock exchanges. But we can learn a lot, and I think we should learn a lot before we get into the stock exchange. Otherwise, what's going to happen? Here's a stock exchange, list your shares, but then you're dealing with companies who you don't know, you don't understand, you don't think they're well regulated, they're not submitting financials. Why would you want to? It's
like the risk is not even still eliminated.
It's not eliminated.
So you just have a stock market, but the risks we are running away from are still there. So in one summary point, what would you say our financial or banking structure is? Are we on the right track?
I think we're on the right track.
Okay.
I think we're on the right track. If you read the MPC report, there's a lot of comfort in the security of the financial system. But let me leave you with this quote. There's a quote that says, a boat is very safe in the harbor, but that is not the function of a boat. So to say a bank is very safe in investing in risk-free investments, government investments, is true, but is that the purpose of a bank?
Thank you. I think we will end the time constraints, and we have time constraints. I would have loved to allow you to dive deeper into that. That is an interesting point, but time would not let us. Until we come back your way next week, this was Money Matters, and I am Malik M. Jallo. Thank you.